If your business profit is creeping past 60K, an S-Corp could cut thousands off self-employment tax. Miss it, and you might tip extra to the IRS. Today, we explain what an S-Corp is, who can use it, how it saves tax, and the rules that stop it from backfiring on busy owners. Stick around for a simple salary versus distribution example with real numbers, plus one pro tip that lets you reimburse yourself pre-tax without playing audit roulette. First, an S-Corp is not a type of company. It is a tax election under Subchapter S that certain companies can choose for pass-through treatment instead. Think of it like a jacket your business can wear. Same person inside, different pockets that change how much payroll tax sticks to your money legally. You form an LLC or a corporation at the state, then you ask the IRS to tax it as an S-Corp by filing an election form. With S-Corp status, the business itself does not pay income tax. Profits pass through to you, and you pay tax on your personal return each year. Here is the twist. Owners who work in business must get paid a reasonable salary through payroll, and profit beyond that can be taken as distributions. Why bother? Because your S-Corp salary is hit with payroll taxes, but pure distributions are not, which can reduce self-employment taxes when profits are healthy enough. S-Corps help when you have consistent profit above roughly 60K to 80K. You work in the business, and you are willing to run real payroll monthly. If profit is small or swings wildly, the admin cost can eat savings. Under that, a simple Schedule C or partnership tax may be cheaper overall. Not everyone qualifies. You need a domestic entity, 100 or fewer owners, only individuals or trusts as owners, one class of stock, and owners U.S. persons. Who cannot? Non-resident owners, other corporations, and most partnerships cannot be shareholders. Some states add extra rules or taxes, so check your state before electing status. To become one, you file IRS Form 2553. File within 2 months and 15 days of the tax year start, or request late election relief instead. Once effective, you set up payroll for working owners. You withhold tax, issue W-2s, file 941s, 940 state forms, and make timely payroll deposits each quarter. Each year, the S-Corp files Form 1120S. It does not pay tax, but sends owners a Schedule K-1 showing share of income, loss, plus credits items. Example, your S-Corp earns 120K after expenses. You set a 70K salary and take 50K as distributions. Salary has payroll tax. Distributions avoid self-employment tax entirely. At 15.3% payroll tax, that simple split can save roughly $7,650 on self-employment taxes before admin costs. Income tax remains the same either way overall. Reasonable salary is not a guess. Use market pay for your role, time spent, location, and duties. IRS expects you to document the basis for number. Distributions are the profit left after salary and expenses. If the business breaks even, there may be nothing to distribute without creating loans or payroll trouble. States matter. Some, like California, add a franchise fee or S-Corp tax. Others need a separate state S election. Your savings should exceed these ongoing costs. Election timing matters. File early for the current year. If you missed it, there is relief if you show cause and act promptly with a pro. Mistake 1. Taking no salary while pulling big distributions. The IRS targets that, reclassifies money as wages, and tax on payroll tax, penalties, and interest later. Mistake 2. Picking a tiny salary using a 60-40 rule you read online. There is no fixed ratio. It must reflect comparable pay for your role. Mistake 3. Paying personal bills from the business account. That creates messy books and can look like disguised wages or loans, which is asking for headaches. Mistake 4. Skipping payroll filings or deposits. Late 941 payments trigger penalties fast. Use a payroll service or calendar reminders so deadlines do not sneak by. Mistake 5. Thinking your LLC is automatically an S-Corp. It is not. Without Form 2553 approval, you are taxed as default, which may cost you more. Mistake 6. Assuming fringe perks are tax-free. For owners over 2%, benefits like gym, meals, and some insurance are taxable wages on the W-2. Here's a money saver most owners miss. Set up an accountable plan. It lets the S-Corp reimburse you for legit expenses without extra payroll tax. Examples include home office, phone, internet, mileage, and small tools you bought personally. Submit a simple expense report, get paid back, and book it properly monthly. Health insurance for a 2% owner can be run through payroll as taxable wages, then deducted on return as self-employed health insurance to reduce income. Pair the S-Corp with a solo 401k. Owner wages allow big deferrals, and the S-Corp can add an employer match, both reducing current year taxable income. Pass-through income may qualify for the 20% QBI deduction. Owner wages do not count for QBI, but ordinary S-Corp profit generally does, subject to limits. Pro tip within the tip: clean books matter more with S-Corp. Track shareholder basis, officer wages, and distributions so your K-1 and payroll tie out cleanly. Estimate admin costs before electing. Payroll software, filings, and bookkeeping add 1K to 2K yearly. If tax savings do not beat that, wait until profits grow. Action step: project your next 12 months net profit. If you expect 80K or more and work in the business, S-Corp might pencil out after costs. Second, check state rules and fees. Search for your state S election or S-Corp tax. Some states need a separate form, fee, or throwback minimum tax. Third, book a 30-minute call with a tax pro and a payroll provider. Ask about reasonable salary, deadlines, onboarding, and monthly cost before you elect. Finally, calendar form 25553. Aim to file within 2 months and 15 days of your start, or attach a late relief statement if missing that window. If this helped, tap subscribe for Taxes Explained. Next up, we break down reasonable salary step by step, with examples you can steal for your plan.